I mean, think back to the last time you bought or sold a house. Or if you haven't actually gone through it yet, just picture the horror stories you've inevitably heard from your friends.
Oh, right. The absolute nightmare of it all.
Exactly. You are sitting at this massive polished conference table, just staring at a literal mountain of paperwork. The air is thick with tension. You're skimming through these documents filled with confusing line items like origination fees, title insurance, escrow fees.
Appraisal costs.
Yeah, all of it. And as you sign your name for the 40th time, there is this unmistakable, creeping feeling that every single person in the room knows exactly how this game is played, except for you.
And it's terrifying, right?
Yeah.
Because you are making literally the largest financial transaction of your life. You're taking on decades of debt, and yet you feel entirely at the mercy of this fragmented system.
Totally.
And people across the table, they hold all the data, and you are essentially paying for access to their expertise just to, push the transaction across the finish line.
Which is wild when you zoom out and look at it, because real estate is really the last major holdout of the internet revolution. I mean, we buy cars online with a tap, we trade stocks on our phones while we're waiting for coffee, but housing...
Yeah, it's basically stuck in the dark ages.
Exactly. But today, we are exploring why that is on the verge of a dramatic transformation. We have a really fascinating stack of source material today. We're looking at the audio transcripts from a recent 2026 investor Q&A session with the leadership of OpenDoor, specifically featuring their CEO and CFO.
Right. And our mission for this deep dive is to cut through all that corporate strategy talk. We want to skip the financial jargon and actually see the mechanics underneath.
Get to the good stuff.
Exactly. We are going to examine how artificial intelligence and blockchain technology are being deployed to take this hyper-complex, deeply emotional, paper-heavy transaction and turn it into something that resembles, well, a streamlined, one-click internet checkout experience.
Which sounds impossible, but you'll want to hear this. Whether you're meticulously saving up for your first mortgage, or you're just fascinated by how ancient, heavily entrenched industries finally get dismantled and rebuilt.
It's a huge shift.
So to understand how technology is fundamentally altering the housing market, we really have to start with the biggest buzzword of the decade, AI. But we need to look past the generic talking points you hear in every single corporate press release.
Yeah, we have to go deeper than that.
In these transcripts, the CEO lays out what he calls the 5-layer cake of AI implementation. Which I love that analogy.
It's a great visual.
Yeah.
And he essentially dismisses the first 2 layers entirely,
Mm-hmm.
like using AI just to draft emails faster, or wrapping a generic chatbot around an existing database that's table stakes now.
Right. Everyone is doing that.
Every company on earth is doing that.
Yeah.
The structural shift actually happens at layer 3. This is the difference between simple automation and true collaboration.
Okay, let's unpack this. If automation is just using a black box to cut 15% of your administrative costs, what does AI collaboration actually look like in practice?
So collaboration means starting with a blank page. You don't ask the AI to fill out an old form faster. You design a completely new workflow where the form just doesn't need to exist in the first place.
Oh, because the system already pulled the data?
Exactly. It pulls the requisite data from municipal records instantly. You're not fixing the old process, you're eliminating it. But layer 4 is where this gets very specific to real estate.
Right, because housing isn't just digital.
Precisely. The CEO points out that housing isn't just moving digital bits around on a server. It involves atoms. It involves physical degrading assets, local weather risks, neighborhood dynamics, and complex human emotions.
And he calls that extreme complexity a structural advantage for the company. Because navigating that messiness is so incredibly difficult, it launches what he calls a Red Queen's race.
Yes, the Red Queen's race.
From Alice in Wonderland, where you have to keep running as fast as you can just to stay in the exact same place.
It's a perfect comparison.
Yeah.
He argues that AI doesn't magically eliminate the complexity of the physical world, obviously, but it helps the company navigate that messiness faster than any human competitor ever could.
Which brings us to the very top of the cake, layer 5. And this targets the core vulnerability we mentioned at the start of the deep dive information asymmetry.
That is the whole ballgame.
The traditional real estate industry is built entirely on this asymmetry. The local agents, the brokers, the inspectors, they profit from the friction of the transaction because they hold the information that the buyer and the seller lack.
Right. And the ultimate goal outlined in these transcripts is to build an AI concierge that completely dissolves that barrier.
This makes me think of taking your car to a traditional mechanic.
Oh, yeah.
Yeah, you bring it in, it's making a weird noise, and the mechanic basically holds your vehicle hostage. They throw out terms like catalytic converter and timing belt, and because you don't understand how the engine works, you just have to pay whatever they demand.
You just nod and hand over your credit card.
Exactly. But this AI concierge model is like handing the driver their own advanced onboard diagnostic tool. It translates all that complex engine data into plain English, putting the power entirely back in the driver's hands.
That's a great way to put it.
It's designed to feel like you have a seasoned real estate expert sitting right there at your kitchen table, walking you through every option. But I do have to push back a little bit here.
Sure.
Does a piece of software really replace the nuance of a local human expert? I mean, buying a house isn't like buying a stock. It is deeply personal. You're thinking about school districts, the feel of the neighborhood, the way the sunlight hits the living room at 4 p.m.
That's a very fair point. But the overarching philosophy in the source text isn't about eradicating the human element entirely. The goal is to upgrade the customer.
Upgrade the customer.
Yeah, you shouldn't be paying a massive premium, which is often tens of thousands of dollars in commission, just to access basic market comparables or to shuffle standard state-mandated paperwork.
Ah, I see.
The leadership argues that most consumers actually want to drive the process themselves. They want the raw data to make the life choice that fits their family best.
Right.
The AI concierge empowers the customer to do that, completely removing the necessity of a middleman whose primary value was essentially simply hoarding the map.
Make the customer the expert so they don't have to hire one. That makes total sense conceptually. But, it is very easy to talk a big game about 5-layer cakes and digital concierges on a corporate earnings call.
Talk is cheap.
Exactly. How does this actually translate into the physical reality of buying, holding, and selling thousands of houses? Let's look at the hard operational metrics the CFO revealed because, I gotta say, the numbers are staggering.
They really are. The CFO provided specific data from the first quarter of 2026. They signed over 5,000 acquisition contracts in that quarter alone. And that volume is the highest they've achieved since the second quarter of 2022. But the critical operational metric here is that their fixed operating expenses were exactly half of what they were back during that 2022 peak.
Half. Literally half.
Half.
They are pushing the exact same massive volume of physical houses through their system, but with half the overhead. And they aren't just hoarding these houses either. The transcripts note that their long-held inventory, like the property sitting empty and unsold on their balance sheet, dropped from 51% down to 10% in just 2 quarters.
And that speed is directly tied to those AI underwriting mechanics we discussed in Layer 3. The CEO actually shared a pretty revealing anecdote about this.
Oh, about the foundation issues.
Yes. There used to be a running joke in the industry that OpenDoor was the best buyer of homes with foundation issues.
Ouch. That is not what you want to be known for.
Definitely not. The implication was that their old, bloated, human-driven systems couldn't effectively screen out properties at scale. They were buying lemons because the manual review process was just too slow and prone to human error.
So how did they fix it? Like, what is the AI actually doing to the file that a human wasn't doing?
Well, in the old system, a single home's file would be touched by up to 11 different people. You had clerks checking municipal data, analysts pulling neighborhood comps, specialists looking at repair estimates.
That sounds incredibly inefficient.
It was.
Yeah.
Now, the AI handles all that heavy lifting instantly. It automatically pulls city permit data, it cross-references satellite imagery for roof degradation, and it parses historical repair invoices.
That's wow.
Because the software does all the administrative toil. Only one human needs to touch the file now. One. And that single person isn't bogged down in data entry. Their entire job is just to verify the AI's flagged anomalies and underwrite the actual quality of the home.
That drastically changes the cost of doing business. During the Q&A, the CEO references that famous Warren Buffett quote, you only find out who is swimming naked when the tide goes out.
Right.
And the CEO makes it very clear that right now in the housing market, the tide is way, way out. It is a brutal macroeconomic environment, high interest rates, frozen inventory.
It's tough out there.
So are they just trimming the fat to survive this specific tough market, or does this metric represent a completely new species of company?
The CEO emphasizes that they have actively chosen to play on hard mode. They aren't sitting around waiting for the Federal Reserve to cut interest rates to artificially stimulate the housing market and, bail them out.
They're embracing the pain.
Exactly. They're using this incredibly unforgiving economic environment as a forge. By forcing the company to operate profitably and efficiently when the market is terrible, they are structurally changing the DNA of the business.
Which means when the market does eventually recover, they have a massive baked-in advantage.
Huge advantage.
But driving down the internal cost of inspecting and buying a home only solves half the problem. If the company is doing all this complex AI underwriting to buy the house, they realize they could use that exact same structural efficiency to finance it for the next buyer.
Which is brilliant.
Let's talk about how this newfound efficiency is completely altering what the end customer pays. Specifically, their attack on the traditional mortgage.
Right. The sources detail a pilot program they're running in Colorado, where they are offering a 4.99% mortgage rate. And the leadership team is very quick to clarify to their investors that this is not a promotional gimmick.
It's not a trick.
No, it's not a loss leader designed to just get people in the door.
Yeah.
The 4.99% is simply what their new AI-driven math allows them to sustainably charge.
To put that in perspective for anyone listening who hasn't looked at mortgage rates lately, the transcripts note that big bank lenders traditionally take about 340 basis points in revenue per loan. Let's translate that. A basis point is 1/100%.
So 340 basis points means the bank is taking 3.4% of the total loan value in revenue.
Right. On a $500,000 home, that is $17,000 just in hidden fees and padded rates baked into the life of your loan. And the CEO has an incredible term for this. He calls it the toilet tax.
The toilet tax.
Yeah.
It's so blunt, but it perfectly encapsulates the burden placed on the consumer.
Totally.
Because that 3.4% tax isn't paying for a better financial product for you. It is paying for the bank's massive legacy overhead. It pays for their physical branch offices on expensive street corners, the expensive corporate lunches for loan officers.
The manual paper shuffling between departments.
Yep. And their nationwide television advertising budgets.
It's like, okay, imagine paying a toll on a modern highway, but the toll booth operators are still using wooden abacuses to calculate the fee, backing up traffic for miles. You aren't paying for access to the road, you are paying a massive premium to subsidize their outdated inefficiency.
That's exactly what it is. It's a blockbuster late fee in the era of digital streaming. But by building an AI-native mortgage platform from day one, they bypass that entirely.
Right.
They have no legacy mainframe systems to maintain. They don't have thousands of loan officers demanding commission on every sale. Because of that structural advantage, they are operating 100 basis points, a full 1% below the market average.
And for the home buyer, that translates to a 10 to 15% lower mortgage payment every single month, which is life-changing money. But my immediate skeptical thought when I read about a 4.99% rate in this economy is that this is a trap.
Ah, right.
It sounds like the classic Silicon Valley playbook we saw with ride-sharing companies. You know, heavy venture capital subsidizes the cost to artificially offer a cheap service. They bleed money to crush the local competition. And the second they have market share, they hike the rates right back up.
Yeah.
How do we know they aren't just doing that, just buying market share?
The CFO actually explicitly addresses that exact concern in the Q&A. Because they don't have the toilet tax overhead, their actual baseline cost to originate the loan is structurally lower than a traditional bank's.
So they aren't faking it.
No, they aren't artificially suppressing their profit margins. The floor is simply lower. They pass that fundamental savings directly to the consumer because offering a radically cheaper mortgage makes their inventory of physical homes significantly more attractive to buyers.
Okay, so they fix the mortgage to move the houses faster. That makes sense. But fixing the financing still leaves the buyer at the mercy of the archaic ledger of who actually owns the land.
Right, the title.
The ultimate vision laid out in these transcripts isn't just a cheaper digital mortgage. It is totally rewriting the foundational mechanics of how property ownership is recorded and transferred.
The CEO goes on a truly fascinating tangent about the history of money to frame this problem. He traces the evolution of transferring value from physical barter to stamped coinage to paper checks.
Yeah.
Then we move to electronic systems like ACH and SWIFT, which were designed decades ago just to move numbers between bank ledgers.
And here is where I absolutely lost my mind reading the transcript. The CEO points out that the global banking system, the infrastructure moving trillions of dollars around the planet every single day, actually runs on a programming language called COBOL.
Yep, COBOL.
COBOL was created in 1959. We are literally running the modern global economy on software that is older than the moon landing.
It completely shatters the illusion of our modern financial infrastructure.
It really does.
We carry supercomputers in our pockets and assume the financial plumbing of the world is equally advanced, but it is incredibly archaic and fragile. And then the CEO pivots to the real estate title system, and he argues that it is 100 years behind even that 1959 banking software.
He talks about how in medieval England, transferring land literally meant walking out into a field, handing over a clod of dirt to the buyer, and having some locals watch you do it so they could swear it happened.
Literal clod of dirt.
Yes. And his point is that centuries later, the only meaningful innovation we've made since handing over that dirt is that the physical court paperwork is now scanned as a searchable PDF on a county server.
That's wild.
We are treating our most valuable, life-changing assets like a medieval land grant. It's insane.
Which leads directly to their endgame, on-chain settlement, sometimes referred to as tokenization.
Right.
Rather than paying a title company thousands of dollars to manually dig through old PDFs and county records just to verify that no one else has a claim to the land, on-chain settlement creates a single, immutable, cryptographic record of ownership on a blockchain.
So no more digging.
Exactly. When you buy the house, a smart contract instantly verifies your funds and transfers the ownership token simultaneously. No escrow officer is required.
Wow.
There are no multi-day wire transfer delays, no missing signatures. They even point to their recent acquisition of Doma's escrow business as the foundation to build this unified checkout for real estate.
But playing devil's advocate again, is putting a house on a blockchain truly necessary? Like, a searchable PDF, while annoying, generally works fine most of the time. Is this just tech utopianism? Like, a massive company building a complicated solution for a problem that doesn't really need solving?
The CEO actually anticipates that skepticism. He points out the massive, well-funded lobbying groups currently fighting tooth and nail to defend the traditional title and escrow systems.
Of course they are.
He compares their lobbying to the famous economic parable, the petition of the candle makers against the sun.
The candle makers want to block out the sun so people are forced to keep buying candles.
Precisely. The current real estate system exists to protect intermediaries. Right now, to move the value of a house from one person to another, you have to get permission from and pay fees to a dozen different gatekeepers. On-chain settlement is simply about removing the gatekeepers.
It's the first time in modern history you can securely move massive physical value without needing anyone else's permission.
Yes, it completely eradicates the friction tax.
But, all of these futuristic visions of on-chain titles and AI checkout buttons, they sound incredible in a pitch deck. The reality is, real estate is deeply tethered to the physical world.
Very much so.
And to our current economic environment. How does the leadership team actually manage the gritty, day-to-day survival of the business while funding this sci-fi future?
Well, the source material spends a significant amount of time grounding the vision in operational reality. They discuss the concept of housing seasonality, which the CEO simply refers to as gravity.
Right, because the shape of the housing market curve is practically a law of physics. Home sales peak in early summer when families want to move before the school year starts, and the market completely bottoms out in December during the holidays. It happens every single year without fail.
And the CEO uses a really powerful analogy here. He says, if you look at Walmart sales in January, they're always going to be drastically lower than their massive holiday sales in December.
Right.
But you wouldn't look at that January dip and declare that Walmart's entire corporate strategy has failed. It is just the natural seasonal shape of retail. Housing has the exact same gravity.
You don't blame gravity when you're flying a plane, you just build the aerodynamic math to overcome it.
Exactly. And to prove to their investors that they have the right math, the leadership team lays out some incredibly strict accountability metrics. They call it the scoreboard.
The scoreboard, what's on it?
They publicly committed to exactly 3 metrics for investors to watch: cohort curves, acquisition contracts, and inventory health.
Okay, what's a cohort curve?
A cohort curve simply means tracking a specific batch of houses, say everything bought in March, to see exactly how quickly they sell and at what margin.
Oh, rather than looking at a muddy overall average for the whole year.
Exactly.
Yeah.
And the leadership explicitly stated that if those specific metrics start failing, it means the company is fundamentally losing.
That is so interesting, because usually corporate earnings calls are entirely dedicated to spinning the numbers to look as rosy as possible. Telling your investors exactly where to look to see if you are failing is incredibly rare. What does that level of transparency do to the dynamic between the company and Wall Street?
Well, the underlying philosophy stated in the transcripts is that good excuses don't make great companies.
Good excuses don't make great companies. I like that.
Yeah. By publicly cementing the exact criteria for failure, the leadership team forces ruthless discipline on themselves. They completely remove their own option to blame the macro environment. If things go wrong, they can't just point to the Federal Reserve or high interest rates. It is a massive signal of confidence to their investors.
And that discipline ties directly into their firm stance on capital. The CEO explicitly states that he despises dilution.
Yes, he used that exact word.
For anyone listening who is unfamiliar, dilution is when a company prints and issues new shares of stock to raise emergency cash, which directly devalues the shares that people already own. He refuses to dilute the stock just to extend their runway.
Right. He says they aren't interested in building a company that constantly requires a life raft. They are aiming to build a ship that floats.
A ship that floats.
That financial discipline is the ultimate proof that the AI integration and the operational efficiency are real. They are fully committed to funding their futuristic growth entirely through the cash flow they generate from being lean. Their survival depends entirely on their ability to operate without a safety net.
But, why should you, the average listener, care about a real estate company's stock dilution or capital discipline? Because a company burning cash and constantly needing a life raft will inevitably have to pass those desperate costs on to the home seller.
Exactly.
A self-sustaining, efficient company is what actually drives down the cost of moving for you. So, bringing this all together, we have explored a truly radical vision for the future of housing.
We really have.
A world where AI collaboration dissolves the information asymmetry that keeps buyers and sellers in the dark. Where an AI-native architectural shift eliminates the dreaded toilet tax on your mortgage.
And where the archaic medieval clod of dirt evolves into frictionless on-chain settlement. It is a vision where the physical transfer of property is no longer a massive, terrifying burden, but a streamlined, transparent digital service.
Because if you ever plan to move, buy, or sell a home, you are currently subject to an embedded friction tax. Between the agents, the title fees, the originators, and the escrow officers, this tax eats up a double-digit percentage of a home's value.
It's a massive amount of money.
That tax is under active, aggressive attack. The future of your personal wealth and the equity you spend decades building in your home might rely entirely on these technological shifts succeeding.
When you drastically reduce the friction and the cost of the transaction, you fundamentally change the economics of mobility. It allows people to relocate for a new job or move closer to family with far less financial penalty.
Absolutely. So, I want to leave you with a provocative thought to mull over. If this grand vision becomes a reality, what happens to the massive, deeply entrenched ecosystem of middlemen? The local real estate agents, the title clerks, meticulously searching those PDFs, the loan officers relying on commissions.
It's a huge sector of the economy.
Right. If the absolute most complex transaction of our lives truly becomes as frictionless as a one-click internet checkout, what does that do to the fabric of our local economies when that entire multi-billion-dollar friction tax industry simply vanishes overnight?
It's a profound question.
It really is. Next time you picture yourself sitting at that polished conference table staring at a mountain of paperwork, ask yourself who is sitting across from you and whether their job will still exist a decade from now. Keep questioning the world around you. We'll catch you on the next deep dive.